So we'll start by working the problem I gave you last class. Put it out there on Blackboard. If you haven't worked this, I'd recommend pausing the video and go out and get this. It's out on Blackboard. It's the last thing under the Schedule P examples, but it's the exam question from last year. So the first thing we're going to do is the 1 year and 2 year loss development for calendar year 2018. So that's the very last column for 2015 accident year. I unfortunately can't highlight them, but 2015 we're going to take 16,808,917, and to get the 1 year development we subtract 16,844,044 from that, and to get the 2 year development we take 16,808,917 and subtract 16,940,445, and that's the 2 year. And you report it whatever positive or number you get, you show it just like that. So the 1 year development is going to equal 1,808,917 minus 1 billion. Oops, sorry. 1 billion. Well, I don't know where I got that number. Let me try it again. 1,680,000. Sorry, my eyes are playing tricks on me. 16,808,917 minus, I'm trying to do this without my reading glasses on, so I'm having trouble just seeing. 044. Did I get those? 16,808,917 and 16,844. .044. Sorry about that. When you do that, you should get minus 35,127. And then the 2 year development is going to be the same. 16,808,917. Oops, this is 16. Wow, I'm having a tough time typing numbers for some reason. So 16,844,044, and then this one's 16,940,445. Hopefully I get these numbers right. 16,940,445, 16,844,044, and 16,808,917, and so that difference comes out at 131,528, and it's a negative number. Negative numbers are good because that means they reserved, or at least it's conservative. It means they reserved more than they needed to in the prior year. So that would be the answer. This first one, sorry about my number issues. I'd put my reading glasses on, but I wouldn't be able to see anything else. All right, so here's the second one. What reserve would you set up for 2016 accident year as of 2018? So 2016, for 2016, we expect to pay out 17,650,000, so 17,650,553. That's the ultimate expected payout minus what we have paid out. So we go to part 3, look at 2016, we paid out 15,725,656. So I subtract that, 15,725,656. So 17,650,553, 15,725,656. So this is paid through 2018, and so that is going to equal a reserve of 1,924,897. And then the last question is, using most recent information, which means your ultimate 2018, how much was 2015 net income misstated? So I'm sorry, 2015. So when you're talking about the income statement in the year, you're looking going down. And in which direction do the 2013 business? All right, so 2015 we had 14,309,311. 14,309,311 total for 2015. But ultimately, we expect it to be 14,112,159. So 14,112,159. So this is what we think now, 14,112. This is what we thought back in 2015. So that gives you a difference of minus 197,152. So 14,112,159 minus 14,309,311 gives you 197,115,2. So in 2015, we overstated our losses by $197 million. So that means we understated 2015 income by 197. So just to make it clear, I don't want you to think we understated 2015 net income by negative 197, but 197,152 is how much we understated 2015 because our expected losses were 197,152 higher than what we think today. Obviously, that'll change again next year. But hopefully these make sense. There's only one more question in this series, and I'll show you that here pretty soon. Might be this session, maybe next session, related to risk-based capital. But these are quick questions at the end. It's just a matter. I just want to make sure you can just get around Schedule P and understand it quickly. It's not a real complex question. You know, you might need to bring your reading glasses if you're as old as I am, but if not, hopefully you read it. I'll try to make the schedule as clear as possible. I use SNP to bring it in there, and it gets a little fuzzy using SNP, as you'll see when we looked at the rest of this annual report. All right, so I'll save that, and you have that. If that's not the answer you got, you know, email me, and if I'm an error, I'll fix it in a future class. All right, so what we want to go from here is if you look online and on Blackboard, I have the entire annual report for Allstate. So I use Allstate just because they do have theirs conveniently available. But it's 600 and something pages. That's why on Blackboard it says do not print, because I don't want you to load it and hit print and then, you know, it's going to use up all your ink and all your paper. So don't do that. What I've done to help you out, though, is I have a second version of this. It's the Allstate annual report, but it just selected pages, so it's only 21 pages. You could print this one if you'd like to, or just watch what we're going to do here. I'm going to walk you through some of this stuff. I'm going to go back to the notes first and give you an introduction to the accounting, and then I do want to walk through some of the annual report. It's really the annual statement. It's what it's called on the statutory side. I want you to be familiar with what this financial looks like. It gives you a huge advantage in interviews. It may not be the most exciting thing in the world, but if you have some sense what is in this thing, you really have a huge advantage. And just when you're talking in interviews and having seen this, you could even try, if you interview with a company like Allstate, try to get your hands on their annual statement. And I'm going to show you there's an incredible amount of information in there that you just cannot get anywhere else. It's tough to do. Allstate has theirs online. If you do it through like USAA does not provide its annual statement online, as far as I know. I haven't seen it yet. Maybe they start or will start at some point. And I doubt State Farm. I haven't looked at State Farm. But if you're interviewing with an insurance company, at least make an attempt to see if you can find their annual statement. You can supposedly go to the state and get a copy of it, or you could even call the insurance company. Maybe they'd send you a copy of it. I doubt they'll do that because they're pretty expensive. But the state probably would not provide you one, but might give you some kind of electronic file. So that's the thing now, is they're more electronic than they are actual physical documents. But MetLife has theirs out there, and I've seen a few other firms. So I think a lot of the firms that are publicly traded, so they have GAAP financials that they have to provide their GAAP annual report. It looks like many of them also provide their statutory financials as well. So if you're interviewing with one of those public companies, then yeah, you probably can get your hands on it. But let's talk through the accounting for insurance companies. A lot of this is true for both property and casualty and life, so there's some overlap here. They have 2 sets of books, and they may have more. They may have an internal accounting that they do, and they definitely have a tax reporting. Insurance taxes are very complex, and what they file with the IRS is several pages. It looks like a lengthy financial statement. So you have GAAP and you have statutory. GAAP is supposed to be more realistic. It's regulated by the FASB, the Financial Accounting Standards Board, and by the SEC essentially. The goal is to help people forecast earnings. So the focus of GAAP accounting is on the income statement, maybe the cash flow statement. And if you go on the Allstate, if you look at Allstate on Yahoo Finance, it's going to be the combined life insurance, property and casualty insurance, and a bunch of other companies as well. You can't just look at the property and casualty company. Unlike what we're going to do in the statutory, and the reason I use statutory and not GAAP is so that we can look specifically at their property and casualty business without the life insurance business being mixed in there. So GAAP does not provide. Now, if you went to the annual report of the company online, they probably give some segment reporting, which they'll probably show some things for the P&C versus the life insurance. But it won't be nearly at the level of detail we can get from the statutory. So statutory is what's dictated by state law. I don't think you can really understand an insurer just by looking at the GAAP financials. I think you need to look at statutory. The way we did it when I started at USA, we did not do GAAP financial statements because USA is not a publicly traded company. And then we got we got a new CEO, but before that new CEO came in, USA decided to start doing GAAP just as a gee whiz, kind of interesting number. And the way we did is we prepared our statutory financials the way we always did, and then we did what we called GAAP adjustments to take us from statutory to GAAP. And I remember looking, and we'll talk through some of those GAAP adjustments and what differences are between GAAP and statutory. The biggest difference is the reserves, because the states require different levels of reserves than the SEC does. And that's because statutory tries to be very conservative. They tend to have lower net income than the GAAP would have. They tend to have lower assets, higher liabilities, and lower net worth. And their goal is to prevent insolvency. So they're focused on the balance sheet, and they're focused on net worth, or what the regulators call surplus. And they provide unconsolidated. They don't mix their life and P&C. Now, they will show a consolidated P&C financial. They were going to do that on the life side. I don't know if they have. There has been some talk on statutory of actually doing a consolidated statutory, but I don't think that's going to be possible because of the complex structure of some of these companies, and you'll see that a little later here with Allstate. So statutory versus GAAP. Insurance companies have 2 revenue sources: premium income. There's a lot of unusual accounting here. I'm not going to go into the premium income too much. We'll talk a little bit about it here a little bit later. So, but we'll get into it. But there are a lot of complexities here. And then investment income, as we talked about, this is their earnings on float. Investment income is a completely separate line, and we'll see that when we look at their income statement. And we always separate these. Now, life and property and casualty are a little different here. For life insurance, they show the premiums, and then they show the investment income next. Property and casualty, they show the premiums, then they show the losses and underwriting, and they have an underwriting gain or loss, and then they do the investment income separate. So it is a little bit different between P&C and life, but both of them clearly separate premium income versus investment income. If you go into to Yahoo Finance and you type in Allstate, so here's Allstate. We do financials. If you look at the income statement, first of all, it's going to show us both their life. Allstate has a large life insurance company, so they show total revenue. That total revenue includes premiums and investment income. Now, if you get their annual report from Allstate's website, where you have more detailed GAAP, they probably will break out the premiums from the investment income. They may even break out the P&C versus the life insurance business. But this financial, if you're analyzing an insurance company, this analysis would just not be of any value to you at all. It's too much is rolled up in that one number. All right, so there's premiums and investment income. Cost of revenues, the way they do that is they have claims they pay in cash, and then they add the change in reserves. They have loss reserves, LAE reserves, and this last one, premium, unearned premium reserve. Now, this doesn't go through incurred losses. It goes through premiums, through revenue, but there's 3 reserves that they have. But the actual incurred losses is claims paid plus a change in loss in LAE reserves, and that's what they show. And we'll look at those numbers. We'll actually see them with Allstate. The expenses for statutory are very similar to that with GAAP. They do depreciation. They do accruals. One unique expense that they have is premium tax. We talked a little bit about that before, but that's a fairly hefty expense for most insurance companies. It's usually 1 to 2% of premiums, so it's a significant number. And they do break that out in their financials, so you can see it. There is something called retaliatory tax. If Texas charges Texas companies 1%, but they charge non-Texas companies 2%, and Florida charges 2% of premiums, and non-Florida companies charge 2.5%, Texas will charge Florida companies 2.5%. So you know, it's interesting. They kind of play these games, and it's really interesting. So you say, hey, Florida charges 2.5% to Texas companies. So instead of charging Florida 2%, we'll charge them 2.5%. So it's called a retaliatory tax. It's very bizarre. It's the way states try to get it after each other. There's a really interesting actuary study where actuaries would actually go into a state like Florida and actually show them that they could reduce their premium tax number and actually raise more premiums and protect their own companies for higher premiums in Texas. It's a bizarre analysis. I couldn't do it right now because I forget all the math and the quirks to it. It's a little unusual. But premium taxes is an important expense. The rest of expenses looks just like your normal, like your regular, you know, got payroll, compensation, rent, those kind of things. We do put federal income tax down at the bottom, separate from everything else, just like they do, like you're used to seeing. Excuse me. Now they have some other things that are really bizarre. One thing they have in GAAP is something called Deferred Policy Acquisition Cost, or DPAC. Both Life and P&C do this. It's only GAAP. Statutory does not allow it. But there's some companies that when they're young and starting up, their underwriting costs and their marketing and their policy service, get anybody set up, and they got to pay their premium tax up front. They've got a lot of expenses up front, so they're very, very unprofitable. And so what GAAP accounting allows them to do is take all those costs for putting the business on the books, and you can actually capitalize that as an asset. You don't have to expense it, and you amortize it over the remaining life of the policy. It is bizarre accounting, and there's something called DPAC unlocking that I won't explain. It's a bigger issue for life insurers and P&C insurers. I had a life insurance actuary explain it to me, and I understood it. And then 30 minutes after he left my office, I couldn't remember. It's just so complicated, but it is something only actuaries can do. So again, there's a lot of the accounting, statutory and GAAP accounting for insurance companies that only the actuaries can do, that the accountants are very dependent. I remember as an accountant doing the financials for the UTSA Life Insurance Company, and we just sat there waiting for the actuaries. And I remember the lady, Johanna, came over, and we were good friends with Johanna because she was our go-between between getting our numbers and the actuaries, and really loved working with that lady. She had a good knowledge. She wasn't an actuary herself, had a good knowledge of what was going on, and so I tried to ask as many questions as I could to try to learn what was going on, which I encourage you to do. Even if you're not an actuary, learn what the actuaries are doing. And the reason GAAP does this is the matching principle. If you got a lot of expenses up front, like underwriting, and that's going to enable you to get premiums the next 3, 4, 5, 6 years, GAAP accounting allows you to take those costs that you incurred to get that business for the next several years and get to spread those expenses out over the next several years. It's possible FASB will do away with DPAC. I haven't heard that they have, so I think it's still there, but it's still something to consider. All right, so we'll talk. We'll start here on the next session. We'll talk a little bit. Again, I promise you, we're not going to go into detail on premiums. I just want to give you a little bit of a sense of the complexity of it. We have a few other things to go through, and then we'll probably in the next session get in specifically in the All States annual report.